Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. It's been an eventful long weekend for everybody here in India because there's so much that's happening across the world that relates to us here in India. Of course, on the global front, you have the meeting between Donald Trump and the Russian President Putin, and that has a bearing on trade between the US and India. There's also the announcement, and this is what is most important, the announcement of a proposal for GST rationalization. And this essentially means that there will be quite a few categories of products and services that will get cheaper if this gets passed by the GST Council. This is being looked at as a booster shot for the Indian equity markets and the economy as a whole. And there's also the bonus of the upgrade of India's credit rating that took place at the end of last week. But let's talk about how fund managers are viewing this. And incidentally, my guest today, Shreyash Devarkar, who's the head of equity at Axis AMC. Shreyash, thank you so much for taking the time. I asked you to join me before knowing everything that would happen. So it's a happy coincidence that has taken place. So first, everything that has happened over the weekend, particularly what is domestic focused, how do you read that? Is this the shot in the arm that the Indian economy and equity markets were looking for?
So definitely, when you look at it holistically, from whatever governments have done over a period of time, including this one. So it is about tax rate, it is about certain policies in state specific which were undertaken, and now this, and even you know that moving ahead in a year or so, there will be a pay commission talk. So holistically combined together, yes, definitely, this is a good development on the consumption front.
Okay, let's delve a little deeper into this, because this is one of several measures that have been taken over the course of the last 12 to 18 months that was expected to bolster consumption. The first, of course, was that cut in income tax rate and the slabs rationalization that took place, and we were anticipating that over the course of this financial year you would see a bolstering of domestic consumption. I guess we're yet to see evidence of that. Would you agree, Shreyash? And there's also monetary policy activity, the fact that interest rates have been cut. All of those factors coming together, we're yet to see some movement on the ground. Would you agree?
Yes, as far as when we observe company results, then definitely one need to look into it, and we have not observed any change in commentary from companies per se. However, one should look at how much is the amount, right? So in the current GST cut, and various experts based on the analogies they've used, the amount of stimulus is expected to be somewhere around 1 to 1.5 lakh. Again, this is just a conjecture as of today, without knowing any details. And if you add earlier one of tax rate cut, which is broadly similar in that sense. So that's why I started with that. It's a cumulative impact one need to see. If you try to see only individual impact of individual steps, then it may not have a impactful evidence. While if you then have a cumulative impact, which will come over a period of time, then definitely it may have a good development. If you go even historically, there has been rate cuts, etc., especially on the GST side. So you don't get direct evidence of, yes, this rate cut has led to so much demand increase. This is always a cumulative impact of monsoon, overall earning, tax, etc., etc. So let's not look at it in an individual development and its impact.
Yeah, that's a good point that you raised. So therefore, let me ask you about the construction of the portfolios that you manage. And of course, you're very closely involved in the overarching equity strategy of Axis Mutual Fund as well. So you're obviously looking further down the line. What are your own expectations that you've built in as you've set your portfolio strategy as things stand right now?
So as far as portfolios are concerned, broadly, the way we are looking at market is there are segments of market where there is established growth and the growth is getting delivered. Those established segments are across the board. They are in B2C segment. So if you take travel tourism, you take airline industry, there is a hotel. In B2C space, even retail industry is doing well, a part of it. In that space, high-end SUVs or high-end car, that segment is doing well. Till some time back, even the real estate was doing exceptionally well. Today, the numbers are not that great, but yes, that continues to chug along as of now. So there are good sizable pockets in B2C space which are doing well. At the same time, obviously, there are pockets like FMCG, they are not doing well. Now, here what market has done is the spaces which are doing very well, they have got re-rated a lot. They have got re-rated to the extent of almost 30-40% to 200-300%. While the spaces which are not growing, now if you take on the B2C side itself, now credit growth, which generally is driven by retail credit growth, that has slowed down. You have FMCG industries growth that is lower. So if you look at, then there is a consumer durable also in some pockets, especially highly penetrated product pockets, there is no relatively less growth. Now this pack is reasonably priced. When I use the word reasonably priced versus re-rated, I'm comparing the valuation compared to the pre-COVID, because after that there has been aberration in data points. So if you compare the valuation compared to the pre-COVID level, then the spaces where the growth is low, which I highlighted later, those segments are reasonably priced compared to the pre-COVID, while the segments where there is a high growth, they are actually re-rated a lot. On the B2B side also, you will observe the same thing. On the B2B space side, the high growth segment are electronic manufacturing services, power capex, power sector capex, defense. So you see, these are the pockets where B2B, on the B2B side, companies have done exceptionally well. And in that context, there also you have seen the multiple re-rating a lot over a period of time. While on the other hand, you take oil and gas, then there is not much re-rating because the growth has not been very high as such. Metal mining, these are the typical areas where the growth has not been high. So the way we are looking at the portfolio is bifurcated in two parts. One is, you cannot just say that I don't want to take a valuation risk, and though there is a growth. So the portfolio comprises of growth sectors which are having high valuation risk, as well as the sectors which are not growing so well, but the valuations are reasonable. There we are choosing the segments where we think that there may be turnaround in near term because of the macros what we are highlighting. So among all the factors which we highlighted earlier, there is, in addition to that, tax rate cut plus GST. Then in addition to that, there is a monetary policy loosening that also is going to have impact. So the cumulative impact of all these things and the plays around that, whichever are available in the market and reasonably priced. So that is one part of portfolio. So portfolio, as I said, comprises of both these, I would sort of say, extremes per se.
Understood. I do want to talk about when you maybe tweaked things, because if I look at a 3-year period or even a 5-year period, Shreyas, before COVID, in the run-up to COVID, a couple of your schemes were doing incredibly well. Post-COVID-19, it went through a bit of a lull, and then back over the course of the last 6 months to a year, they're once again ranking higher. So I'm wondering what has gone into the tweaking of strategy that has helped you do this, if you can take us through that.
At Axis, actually, broadly, when it comes to philosophical investment, our philosophy of quality and growth, that has not changed. It continues. The only change what you would have observed in our portfolio, and that is more to do with the economic development rather than anything change at our end, which is more number of stocks, more number of sectors, which never used to be earlier. So earlier the portfolios used to be very compact, maybe some portfolios in 20, 30, 40 stocks kind of portfolios. While at that time the economy was narrow, when it comes to the listed space especially. Now, if you look at, as I highlighted, the pockets of growth, They are both on the B2C and B2B side. And then there are segments where there is a possibility of turnaround because of the overall macroeconomic development. So the net outcome of that and the net outcome of economic structure the way today it is, the portfolios are more diversified as such. That is one. If you want to highlight what is a change, then this is a change, and this change is more because of economic developments rather than anything we are thinking differently out here. Secondly, why again there is an improvement as you are highlighted over the last year or so, is again the market. On the other hand, if you notice that market has started consolidating in a manner. Uh, if you look at the success rate has drastically reduced. So in that sense, whenever such thing happen, generally the companies which are having better ROEs, better free cash flow, and are having superior growth, they tend to outperform the broader market, because here the valuation re-rating is done now in this market. So you cannot expect valuation re-rating. Even when I said there are segments which are reasonably priced, they are reasonably priced. They are not cheap at all. And in this context, valuation re-rating is very difficult. So when you stick to quality and growth, then that also has started playing out in the market over the last 1 year.
Yeah, you have these themes that move out of favor and then move back into favor. As you've pointed out, quality seems to be moving back. Now, help me understand one of the questions that I often try to ask fund managers, and I know that you're head of equity, but of course you would weigh in the hybrid strategies also to a certain extent. And the way that you're positioning yourself in your hybrid strategy, particularly the dynamic asset allocation fund or the balanced advantage fund, would indicate to your investor how you're viewing the current scenario. So how is that currently, equity versus fixed income, and where is it likely to move in the medium term?
So in this space, if you will just see even historically over last 1.5 years, let's not take back into long-term history, we have moved a lot, right from 70% or to 50%, then 55%, and definitely we are now lower than those 70%. So we are actually in that 50, 55, 60. So that thing moves based on the developments in the market. Our view in this space has been that the way I highlighted in our other funds as well, that there are spaces which are very expensive, but they are growing. And there are spaces where there is a lack of reasonable growth, but they are reasonably priced. And in this context, as you are observing that already, as it is reflected in 1 year returns of large cap, mid cap, small cap, the returns are suboptimal in all the categories. And the net outcome is because of this. I'm not saying that there is no growth, but where there is a growth, the valuations are not really in your favor. In some cases, you are observing that despite if a company, instead of growing at 20%, they grow at 15% and the stock falls. Now, because the expectations are very high when the stocks are trading at 70, 80p, and 15% is not a bad growth at all. And considering this, we have adjusted our hybrid portfolios to the lower exposure to equity over last 1 year or so. It's not very low. As I said, the bottom of stock picking will play a major role here, and in my opinion, more so in case of hybrid funds, rather than taking a call on whether the exposure is say 60% or 55%, that would not make much difference. In that 55%, what you are owning and what you are not owning, that is going to play a major role, and our focus is especially on that.
Yeah, you said it. And margin of safety, I think, is what people look for, right, Shreyash? So therefore, in the broader market funds, and I know that the mid-cap fund is something that you've been looking at for so many years now, would you say that, relatively speaking, the broader market funds, there's less margin of safety, given everything that we've seen? For Nifty 50 earnings, I think a lot of people will agree they're more or less in line or even better than some had expected. But are you seeing that in the broader end as well?
And that's where one more observation starts, because you highlighted they are in line with expectations. What is happening is over last 1 year, actually the expectations have already come down. Market have cut a lot the expectation for FY26. probably some of the strategic expectation is running in high single digit. And on those lowered expectation, you are not seeing further disappointment. That is a good part for FY26 as such.
We're running out of time, but very quick last comment, Shreyash. Usually ask fund managers to send out a message to their investors. What is your message when you talk about return expectations and how to benchmark them?
That is the easier one. Actually, always the answer to this question has been that expectation from equity market should be closer to nominal GDP growth. So historically, it's based on historical evidence. Historically, whenever nominal GDP growth, whatever it has been, the equity market last cap would have given 1-2% plus minus return, and mid cap additional 1-2% plus minus returns. So this has been the range over longer period of time, and one should go with that kind of expectation, especially when the market is already discovered and most of the growth segments are highly priced.
Fantastic. Shreyash, always a pleasure speaking with you. Thanks so much for taking the time.
Thank you very much.